right, are we good to go? I think we're good to go here. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. Hey everyone, how's it going? At the Amateur Investors here, or actually, I guess should I say the Amateur Investor. Ben's not here. Don't worry, I don't want to scare people with the title. Ben's just on a business trip. He just started a new job over a week ago, and he's traveling this week, and we just couldn't sort out what time to get both of us on a call together. So he's out in California just with the time differences too tough. So I'm just taking the reins this week. It's probably going to be a much shorter episode this week. And, I'll just give you the highlights of everything going on in the investing world, just kind of like a news topics and such for you all. So it's definitely a different show for sure. I hope you guys still enjoy it with or without Ben. But yeah, glad to get him back in the next episode. So anyway, as you can tell, I'm wearing my Italian soccer jersey. I do have Italian heritage. My dad is Sicilian and my mom's family is from Naples. So I do have, 50% Italian, quarter Polish, quarter Irish, but I was definitely cheering on Italy for the Euros. Very thrilled that they beat England in the final to win. It is the first time I'm seeing my team, any of the sports teams I follow, since they won in 2006, the World Cup. So I'm very glad that I'm older and of drinking age. It was definitely fun watching them win. Very, very cool win. I guess I'll go right now into product promotion. So I know we've got cool mugs. We've got the Amateur Investors t-shirts. We've got the Ask Me About My Bitcoin. The shop is doing well. You can find it on our website. Really cool stuff on there. We've got more announcements on the way. We apologize that we haven't had more announcements, so we've just been really busy with Ben changing jobs and, just kind of the chaos of everyday life. But we promise in the coming weeks, we got some really exciting stuff coming your way. So let's get right into it. After Italy winning the Euros, pretty ecstatic and stoked about that. But let's get right into it. So I'll share my screen right now. So what we're right now is looking at the S&P 500. It's up over the course of the year. It's up 38%. So if you think, I know Michael Saylor, he's the CEO. He's the CEO of MicroStrategy. He was kind of saying, how do people judge inflation? And obviously, Ben and I have talked about it on our inflation episode. It's a very personalized measure. If you live in your parents' basement like me, and your rent's much cheaper, your cost of living, all you have is beer and pizza, that's going to be a very different reflection than someone that's trying to buy a new house, which I actually did. So I guess I'm in that category as well. But compared to someone who's buying a new house, new home prices are up 24% this year. If you're just trying to dollar cost average into the S&P 500 index, if you're looking at Bitcoin's price appreciation since a year ago, if you're looking at all these different factors, that's kind of the inflation that you're factoring in. So if you're looking at it, the S&P 500 is up 38% or almost 39% this year. But if you're thinking we printed 25% of the 25% of the currency into circulation, that's when you're doing your real cost basis, or basically you're adjusting for the inflation of currency. That's really, if you're thinking 39 minus the 25, it's really 14% gains, which even if you're thinking about is pretty, crazy when you think about the year that we had with many small businesses shutting down, with many people losing their jobs, many people dying of the coronavirus. So it's just been kind of a chaotic time, and it's hard to think that the economy is 14% better if you're thinking about, this time to this time last year. So that's basically just showing, as Ben and I keep harping on, assets and these things aren't getting appreciating. It's the currencies getting devalued. So the people that are buying stocks, equity, bonds, real estate, anything, you name it. The reason all those things are going up in value, even used cars, which we're seeing as like a really bad signal when used cars are going more for new cars because of just demand, and there's not enough supply to meet the demand. For something that's traditionally a depreciating asset, or it is a depreciating asset, yet people are willing to pay more than what they bought it for. So it's not signs of a healthy economy. So if you think about it, the S&P 500 index is up, 38, almost 39% this year. That's crazy. I know Michael Saylor said, doing something was more hazardous than doing nothing was better than doing something. A lot of the hedge fund managers and people on Wall Street are saying, they just stayed in the Hamptons, on floats or their private yachts or whatever it may be, and they had the best year that they've ever had in their lives. I don't think that's really bringing value. There's definitely argument to be made whether stockbrokers actually bring value to you or to me or to anyone in retail, really, or even anyone that invests with them. So that's very interesting. The Nasdaq in the same year time span is up 46%. So that's obviously more heavily weighted towards tech stocks. Yeah, I think McDonald's is in and a couple other more brick and mortar stores, but definitely they have a higher, the Apple, the Amazon, the Googles, the Facebooks, that they're more in the tech sector. So even though tech was up a lot, there's definitely been a sell-off and rotation back into more value stocks or into quote unquote less risky assets. With that being said, we're now going over to the Buffett indicator. So, as we were saying before, Ben and I brought this up multiple times. It's in our newsletter every week, that Warren Buffett sees if 100% is the baseline, meaning 100% Warren Buffett indicator means that the market is completely fair valued. Means like nothing's overvalued, nothing's undervalued. 70% would be extremely undervalued. 130% would be overvalued. We're at 207%. That's extremely, extremely, extremely overvalued. So there's just kind of, for all the bad and rot that was with the economy, it's not showing signs that things are healthy, which is, very contrary to popular belief. Obviously, if you're putting your money into these assets and they've gone up, you feel richer, whether it's your home price appreciating, your stocks or equities going up. Basically, it seemed that buying pretty much anything has gone up in value. And I don't know if that's necessarily a healthy thing. Obviously, Ben and I was talking about reversion to the mean. So, what goes up must come down one way or the other. I'm not saying it's going to crash completely to zero, but that doesn't make sense. But definitely reverting back to a lower cost basis would make more sense. And I know that's a quote that we've had that actually did pretty well. It was, money is made in the green, but wealth is created in the red. So right now, aside from dollar cost averaging to my 401k, dollar cost averaging to Bitcoin, I'm not seeing any crazy opportunities. I'm also a little strapped for cash with just buying a home, doing some work on it, little odds and ends things and upkeep. It's overall a new home, but there's not crazy. I don't have a lot of excess cash, let's just say, to invest in a lot of things right now. I'm trying to build up my reserves to take on bigger positions. Now moving over to the usdebtclock.org. This is a pretty great website that I love to look at. Basically right now what you're looking at, so for those that are listening in the podcast, you can't hear, but I'll just talk it out. U.S. national debt is sitting at $28 trillion, quite bigger than what it was even just a year ago. I think it was sitting at 21 trillion or maybe a little bit higher than that. Right now, if you were to think about, I love looking at this, the U.S. federal debt to GDP ratio, which is basically how much debt the federal government has compared to the global domestic product. So basically, your exports and the things that you're producing in the economy. So back in the 60s, it was at 52%. The 70s saw a pretty high inflation to counteract, or pretty high interest rates to counteract inflation that they saw going on. And actually, the Federal Reserve was selling off a lot of their equities to actually quite a more healthy economy. So 1980 was showing only 34%. So we had 52%, 34% in the 80s. In the 2000s, we're at 57%. And then right now, it's showing that, or actually, I think right now should actually be 2020. No, it's right now. Yeah, right now, it is at 128%. So if you think about it like this, if back in the 60s, you were making $100,000 salary, I know not everyone makes that. That's more than I make, full disclosure. But if you're thinking about just for a cost basis, if you're making $100,000, you'd owe $52,000. In theory, if the U.S. were to default on its loans and we were to owe back our money immediately, you would owe 52% of your salary in order to pay for all the deficits we had. The 80s, you'd owe $34,000. 2000 back up to 57 or a little bit higher than in the 60s. Right now, if we were to default on our debt, if you're making $100,000, you would owe $128,000. I know this is, hard to wrap your mind around. I'm not saying that this is going to happen. We're always kicking the can down the road for who owes what. Basically me and my kids and my grandkids are going to be the ones that are going to be picking up the bill until basically we see economic collapse. So maybe it'll happen in my lifetime. We'll see. There's going to be crazy economic times in front of us. But basically it's saying we're spending way more than we are making. And, that kind of seems to be the consumerist, the United States or the American mentality of spending more money than you make. I know a lot of other cultures, whether it's, Indian cultures, they believe in saving. But while they believe in saving, they're hoarding their money and saving money, not so much as investing. They see investing as risky. But when you're saving money, if the government's printing away money, that kind of drives the behavior that you're losing purchasing power. So, on the one side, if you're saving it in, a checking account or a savings account, that can be just as detrimental if you're, overspending what you can be. So there's obviously spending money on assets instead of liabilities. If I'm just buying a car, I'm buying clothes, or I'm buying things off Amazon, those are liabilities. Those aren't assets. Whereas if you're buying Amazon stock, or if you're buying a house to rent out, or if you're buying all these different things as assets, you definitely love inflation because you're seeing your assets inflate in price. Or another way of saying that is you're watching the US dollar collapse relative to it. So that's obviously not a good thing. And obviously, we are in this consumer-driven American mentality of overspending. But I will be the first to admit, the U.S. government's not buying assets. They're buying liabilities. They're saying an IOUs, whether it's in the form of bonds or buying, at this rate, they are buying treasuries, I guess, as a hedge with buying, the debt of a lot of these equities or companies, basically. I guess that's just really baffling to look at. It says total debt to GDP ratio. So one is federal debt. The total debt is states, local, and basically all debt. So you're including not just the debt of the Fed, but also the states and local governments as well. So that's 143%. So that's even worse when you lump it all together. So pretty crazy. I know these are pretty astounding numbers. Like I said, right now, if debt divided among all citizens, so this is even babies or newborn babies, even people that are on Social Security, everyone, we would owe $85,000 right now if we were to get all our debts called at once. That gets even worse when you're considering only taxpayers, which if you think about it, real taxpayers, if you're 14 or 15 starting a job all the way to about 65 or 70 when people are retiring, that's just taxpayers. That's excluding the extremely old of our population. That's also excluding all the children in our population. So debt of citizens divided evenly among everyone, $85,000. Imagine being born and you owe $85,000. You haven't done anything, good or bad for the economy, and you owe $85,000 versus just the debt for taxpayers. So people, that are still in the working world, $226,000. It's really hard to fathom these numbers. They're pretty, you can't even wrap your mind around these numbers. So I will be the first to say, and I think Ben agrees if he was here, it's not signs of a healthy economy. Going over to the daily treasury yield curve. So this is the rate of the bonds. So I know Ben and I always harp on normally the 5-year bond. So right now, back a week ago or 2 weeks ago on July 1st, it was at 0.89% of a bond. And then, if you look to today, it's 0.81. So that means that people are actually buying more. The bonds are showing, it's a free and open market. Basically, people are buying or selling bonds as they see fit. When numbers are going down, it means that people are buying them up faster than bonds are going on the market. So the price or the percentage is going down on your return, meaning that if the bond were to go up, it's incentivizing people to buy. So if an easier example is, let's just say the 5-year treasury was yielding 1%. If all of a sudden they were to jump up to 10%, it means people were trying to sell them off or get rid of U.S. debt as fast as possible or bonds because they see them as risky. So then the percentage has to go up to incentivize people to circulate their money back into it. It's a free and open market. It's the way, markets should really be. Right now with the Federal Reserve buying bonds at record rates, I know Ben and I talked, I think it's $120 billion per month. And they said they, won't stop to keep the economy going. That's not necessarily a healthy thing. With bonds going further down, that means that on top of the Federal Reserve buying it, obviously retail and institutional investors are buying it as well. So, and then with the latest inflation numbers coming out with, I think, just shy of 5%, if Ben and I were talking about this in the inflation episode, if you bought a 5-year bond, inflation has literally wiped out your purchasing power. Yes, the number in your bank account will be the same. We're going to give you, let's just say it's to make numbers easy. You give me $100. I'm the Federal Reserve, the federal government. Let's just say, to make it easy, it's 1% instead of 0.8. So if it was at 1%, that means in 5 years' time, I have to give you $101 back in 5 years' time. So right now, if we saw 5% inflation, yeah, I will give you $101, but your purchasing power has eroded. So if you subtract the 5% inflation from the 1%, you're getting a 96% purchasing power. So that means you put $100 in, it grew to $101, but the $101 is only buying you $96 worth of goods and services that it does in 5 years' time. That's not even including if the inflation numbers start to get even worse. And I know they're saying CPI is 5%, and they're calling that transitory. Janet Yellen and Jerome Powell keep saying that. Ben and I say, if you're buying a home, inflation numbers are 24%, 25%. If you're buying lumber this year, lumber's up like something absurd. It was like, I think it was up like 400%, 380%. It's like crazy. Yeah, lumber prices are starting to come down as lumber mills are coming back open after, COVID closed a lot of them down, but it's still just absurd numbers. So, that's kind of looking at the bond market showing that the numbers are going down. I don't know if that's a good thing or bad thing. If you're seeing a sell-off and the interest rates are spiking, I think that would be more worrisome, although remaining flat, going up or down, it's just kind of hovering around what it is. And then BitBo, this is a website that I use. This is normally for what I use for looking at block times, block height, all these different factors about Bitcoin. It's a very useful website. So obviously on the one-day chart, Bitcoin opened 24 hours ago or yesterday at 34,000. It is down to 33,000. So it is down 3.86% on the day. Not quite sure why that's down so much. I know probably along with the hash rate dropping and, Chinese miners are looking for places to plug in and go, whether that's the United States or Kazakhstan or places in Europe. I hope to see that we'll see the price going back in the other direction. Right now, $1 US dollar can get you 3,025 Satoshis, or, 1/100th of a Bitcoin. I think that's a bargain. If I had more cash on hand, I would be lump summing it into Bitcoin right now. But like I said, I kind of have some liabilities to cover with the new purchase of the house, the mortgage, insurance, my car, all that. So definitely something to be wary of. I'm still dollar cost averaging in. I do typically $15 a day is what I do. And then when I get extra cash flow, I've been buying that. If the stock market were to crash or housing prices were to crash, I'd maybe consider trying to buy another piece of property potentially, or upping my dollar cost averaging into the S&P 500 index. With all of that being said, that's pretty much all we got today. Oh, and then this is also a cool one. So this is a 1 day for logarithmic chart. This is Bitcoin's price on a logarithmic scale. So as you can see, basically when you write it on a logarithmic scale, you're just seeing that the chart is going from the bottom left all the way up to the bottom right. I mean, it's, just appreciating in value by that much on a logarithmic scale. I think it's really cool. I just think it shows the power of the Bitcoin network. And you can kind of even see the halving adjustments built in as it spikes up, crashes down, consolidates for a few years, and then spikes back up. And then it's, slowly working its way up from back in 2010 is when they first started recording it, July 12, 2010, at 1 cent per Bitcoin, 1 penny per Bitcoin, to now at the price we are today of $33,000 per Bitcoin. Over the lifetime of Bitcoin's existence, it has seen a price appreciation of over 330 million% increase. Those are pretty absurd returns. Obviously, that's comparing if you had a dollar cost average of a penny, which I do not. I wish I did. I'd be doing a lot better off. But Bitcoin's averaging on year 191% returns. If you think about it in comparison to the S&P 500 index and the Nasdaq, the S&P 500 is up 38% this year. Nasdaq's up 46% a year. On average, I think S&P 500 is normally 7 to 9%. you think about the Nasdaq's normally 16 to 18% because of all the tech stocks and how they've done over the last, 5 or 10 years, and even more so the last 5 years, just how much better that they've done. So yeah, that, like I said, thanks for listening. Apologize for not having been here. We're going to have another episode next week with both of us. It'll be a lot longer and a better format. Like I said, if you want to pick up a nice mug, the Amateur Investors mug, I think it's some nice stuff. If you want to pick up some apparel, whether that's the Ask Me About My Bitcoin t-shirt, we got it in black and white, or the Amateur Investors t-shirt, also in black and white. Really appreciate you guys listening, and we're so excited to have a few more announcements in the coming weeks in July and probably early August. So thanks for bearing with me. Remember to like, comment, subscribe. Follow us on YouTube, or subscribe to us on YouTube. Follow us on Instagram, Twitter, TikTok. I keep saying I need to do more work on there. I promise I will get more there. Facebook, our Facebook group, LinkedIn, or our website to see where our merch is. All the links for that are in our bio of all our social media platforms, or you can go right to our website, theamateurinvestors.squarespace.com. So thanks, everyone. I'll catch you next week with Ben back by my side, and have a good week.